Hi everyone, I'm Colin, Assistant Manager of iFAST Research Team, and it is good to see everybody back here again after a long battle with COVID. And last year was a great year when it comes to COVID for Singapore, but it wasn't that great for equity markets at all. I'm sure many of you guys know that as well. And unfortunately, last year was a roller coaster ride, and there were many ups and downs in markets, and also for investors' emotion as well. But mostly, this roller coaster headed down. So with central bank expeditiously hiking interest rates, we think that the recession is an outcome, unfortunately. And with that, many investors may think to themselves, okay, what other markets are we going to invest in? And especially if we are downgrading our long-term view on China, our long-term positive view on China, then what other markets are there to invest in? So with that, today I'm going to share 3 ideas that we are positive and we are excited about heading towards 2023. So let's begin. Alright, but first let us take a quick look back at equity markets last year, and there were several defining moments that shaped equity returns last year. As you can see from the slides here, we do have the Russia-Ukraine war, which is unfortunately still ongoing. We have the persistently higher inflation, and that drove the Fed rate hike as well as the rate hike cycles around the world, and that led to a global growth slowdown. And unfortunately, elsewhere around the world, we also have troubles in China with COVID issues, with the real estate issues. So collectively, these factors dragged global equities down by 20% last year. And in fact, across the world, most markets delivered negative returns in Sing dollar terms. And if you can see from the chart right here, only 2 markets stands out, Brazil and Singapore. They were the top performers and only positive returning markets under our coverage. The other markets all delivered negative returns between -1% all the way to -29%. But that said, after this heavy drawdown, equity markets are right now trading much cheaper entering 2023. And while the risks are still present and the risks are still prevailing, and we do see opportunities in several markets. So let me share the first market that we're positive about, starting off with Japan, which is one of our top picks entering 2023. So the first reason why we like Japan is the reopening tailwind, which we expect to keep consumption strong and thereby supporting economic growth this year. And we see this playbook in US and in Europe, and we believe it will repeat itself again in Japan. So driving this reopening tailwind is a very strong tourism spending. And this is important because Japan's tourism sector is an integral part of the economic growth, which, as shown on this chart right here on the left, you can see that it contributed about 7% of its GDP in 2019 alone. And the jump in inbound tourism in Japan is almost 5 times compared to last year as of the end of October. And based on tourism projections, it is likely that tourism spending itself will be full-blown this year. And this will directly support already resilient economic domestic consumption in Japan, which have started to accelerate when the state of emergency ended last year. So this is shown on the chart on the right, where you can see that the growth of consumption has sped up after the end of the state of emergency. So with consumption nearly 2/3 of Japanese economic growth, we think that the consumption-driven recovery itself in 2023 will keep the economy resilient at a time when global growth is softening and global export demand is weakening. And the next reason why we like Japanese equities is because of its balance sheet strength, and which we believe will be extremely valuable when global growth slows down, as Japanese companies can deploy this massive cash reserve not only to defend but to recover operating expenses. And Japanese corporate balance sheet strengths are in a strong position. As shown on the chart by the right, you can see that the sum of cash and cash equivalent and its ratio to current assets have surged over the past decade to a near record high. In fact, close to 50% of the Japanese listed companies are net cash, as shown on the chart by the left. And you can see why this is impressive, because this is almost double that of US and European listed companies. So the next reason why we like Japanese equities is because of its very attractive valuations. So the region itself right now is currently trading at a gaping 22% discount to its long-term average in terms of its forward PE ratio. So valuations right now, as we find, are abnormally cheap, and as such, low entry valuations, this sets up for potentially attractive longer-term returns, which is hard to find even in today's environment. So lastly, Japanese equities, we believe, should benefit from currency tailwinds, and we expect the yen to march higher against broad currencies in 2023 from a deeply undervalued level. And as shown on this chart right here, the yen right now is trading at its all-time low since 1980, and on a real effective exchange rate basis. So while a stronger yen, some may argue, may dampen overseas earnings, we think an appreciation from the current extreme level will not materially hurt Japanese corporates, at least not in the near term, because the effects tend to lag and companies do hedge their FX. And overall, we do see that this tailwind itself may drive the FX return, enhancing the overall Japanese equity return. So to summarize, these are the 4 reasons why we like Japanese equities, and we see a steeper than expected global recession, as well as a faster pace of BOJ tightening as key risks to watch out for. But looking ahead, we do expect an upside potential of 40% by the end of fiscal year 2025, which is by March 2025. So for investors seeking exposure to Japanese equities, we also do recommend an unhedged share class due to our views on the yen. So next up is US equities. While many may agree that the region has been hit very hard last year, we do see better performance this year, and let me share some of the reasons why. So firstly, we are less pessimistic on the US growth despite a potential recession. While we expect growth to slow, we do not think it will slow like what we've seen in 2008 or even at the start of COVID. So we believe that US consumption, which is a major growth driver, is likely to buffer against a deeper slowdown. And there are several macro indicators pointing to a resilient US consumers. But today, I would just like to highlight the current strength of US household balance sheet. So in a nutshell, simply put, the household liquid assets, which comprise of your checkable deposits, your currency, your money market funds, and all that together, they have climbed to an all-time high, giving consumers greater ammunition to spend. And at the same time, there are lesser immediate liabilities for household despite higher debt. As you can see from the chart by the right, debt servicing costs as a share of disposable income have fallen significantly, especially after COVID when the income of the US consumers went up. So net-net, we do think that US households are definitely in a better position now than in 2020 when COVID hit, and that should buffer against the drag from a deeper recession. So on the topic of a recession, we find that the median drawdown of a US recession from peak to trough for US equity prices was around minus 25%, as you can see clearly from this chart right here. And this is in line with our expectation of a mild recession. And with the US already declining about minus 18% from last year's peak, we do think that a lot of damage has already been priced in. And it is likely that there may be further market weakness coming from corporate earnings decline as we move ahead with the year. But if history serves as any guide, we do think that further drastic drawdowns might be limited. And comparing that against last year, this means that the risk reward for US equities have actually improved. So regarding Fed funds rate, we expect it to peak around 5% before going on a pause for the remainder of the year. And you can see that with the Fed fund rate forecast that we have right here on this chart. And this is important for US equities given its larger concentration of longer duration assets, or you guys might know it as growth assets, which have a large amount of cash flow accumulated over a longer term period. And this makes US equities very sensitive to changes in policy rates. And therefore, equity weakness driven by higher rates should subside if rate hikes are removed from the equation. So to be clear, the pressure on growth stocks will likely stay, but may not worsen when the Fed hits the pause button. So nonetheless, we do see that this factor should be enough for equity prices to find support. So to illustrate this, here is a chart of the 10-year US real rates and S&P 500 forward PE. As you can see clearly right here that whenever the real rate spikes, which is denoted by the green line right on the chart, the forward PE, denoted by the purple line, compresses and equities take a hit as a result. However, with an impending Fed pause and a potential peak in nominal yields, real rates may ease this year and equity valuation may see less pressure. So to summarize, unlike Japan, where we see several tailwinds, the case for the US centers more around the fading headwinds. And the fact that a lot of the damage has been priced in makes us more optimistic regarding the risk-reward moving forward. And we see an over-aggressive Fed as a key risk, as this raises the odds of a deeper recession. But nonetheless, looking ahead, we do expect an upside potential of around 11% over the next 2 years. And we do think that investors should fare better with a value-focused strategy because US value right now is still supported by the high inflation, the interest rate hike environment. And it also faces less risk from the upside in inflation as well as less risk from an overly aggressive Fed. Right. So after turning negative on China, as illustrated by my colleague Weiren, and after downgrading several key Asian markets like India, like South Korea, even Hong Kong, we have decided to dial back our optimism for Asian equities. However, ASEAN is definitely a region that we still like, and we find it to be a more resilient expression for Asian equity exposure. And let me share a couple of reasons why. So first, we think that ASEAN should see relatively stronger economic growth and milder inflation headwinds this year. We expect ASEAN to grow at a stronger pace compared to major economies, supported by a few factors, mainly China's reopening, Thailand's tourism-led growth, and also Indonesia's commodity support growth. And furthermore, ASEAN inflation is also less dire than what we see in the West. And inflation in ASEAN right now, across the major economies, are either peaking or has already peaked. And as a result, ASEAN central banks have been and will continue to adopt a less hawkish response, and that should be less damaging to the region's growth. Since COVID hit, ASEAN earnings have lagged regional peers and consensus have remained rather pessimistic. As you can see from this chart right here, EPS estimates have barely rebounded since 2020, and they are only right now slightly above the historical low. And on top of that, you can see that for the fiscal year 21 and 22, they have been revised downwards. So all that are indicators of how pessimistic the consensus have been regarding ASEAN's EPS. But we believe that the consensus has definitely priced in a significant negativity, which becomes obvious when you compare against the ASEAN's economic outlook shown on my previous slide, where things are still very rosy. So when you compare both, we do see that there is a wide disconnect between both. So given how pessimistic estimates are for ASEAN EPS, we see very limited room for EPS to fall further as we head into a potential recession. And this means that there could be a smaller magnitude of earnings-driven downside for ASEAN equities this year. And the other reason why we like ASEAN comes from a portfolio perspective. So we like ASEAN as we find it to be a more resilient expression for Asian equities. So let me highlight two supporting data. Firstly, comparing to Asia ex-Japan, ASEAN demonstrates half the correlation to China, but almost the equal correlation to US and global equities. So what this means is that for investors, they can substitute ASEAN for Asia ex-Japan to cut correlation to China by half while maintaining equal correlation to the US as well as global equities. So this can significantly reduce China-related downside risks. And we believe this is helpful given our negative view on China itself. So secondly, Asian equities is more volatile than ASEAN, as you can see from the chart by the right. The 12-month volatility for the equity return for ASEAN is almost half that of the Asia ex-Japan equities. And as you can see quite clearly, and the reason why AXJ or Asian equities is so volatile is because of China. And then China's equity volatility has surged over the past couple of months especially, and that has driven the Asian equities volatility so much higher. So with that, you can see that these two factors strongly support the fact that ASEAN equities are definitely a more resilient equity exposure when it comes to the universe within Asian equities. And lastly, we believe ASEAN will be one of the biggest beneficiaries from the shift away from China. And according to US trade data, since 2018's trade war, the greatest export beneficiaries have been ASEAN countries. As you can see from the chart by the left, exports to the US from Cambodia, Vietnam, Laos, Thailand, and even Indonesia have all seen a sizable jump. And this trend is also not limited to just the US. In fact, both Europe as well as China have also been importing more from ASEAN as well. And overall, we see this as a long-term tailwind for the region as the shift of supply chain away from China and to ASEAN economies is arguably only still at its early stages. So to summarize, here are the 4 reasons why we like ASEAN equities, and we see a steep global recession as a key risk, especially if Asia's export demand is severely hampered. But looking ahead, we do expect an upside potential of around 20% by the end of fiscal year 2024, making ASEAN one of the more attractive equity region upside-wise alongside Japan. Alright, so with that, I've come to the end of my presentation, and I will leave you guys with this summary slide on the 3 markets and the recommended products to go along with it. But before I conclude, I would just like to say that yes, the investment environment have definitely changed. No longer we are in the low rates and a low inflation environment. And if policy rates and inflation remains higher for longer, perhaps 2022 was just the opening chapter and 2023 might not get easier. That said, not all chapters have a bad ending and not all chapters have a bad narrative. Equity markets may face more challenges walking into a recession, but as per every recession, there will be a recovery. And with that, I've come to the end of my presentation. Thank you and have a great year ahead.